The United States stock market is currently closed, and as of the latest official session closing data on July 16, 2026, UiPath Inc., trading under the ticker symbol PATH on the New York Stock Exchange, sits at a current price of $11.94 per share, marking a modest intraday upward movement of 1.22% during the regular trading day. While the headline numbers indicate a quiet, range-bound equity, the structural reality underneath the hood tells a completely contradictory story. Most market participants looking at their retail screens assume that this enterprise is merely grinding sideways along its cyclical bottom, waiting for general tech tailwinds to lift all boats. The unexpected technical reality, however, is that institutional block accumulation has quietly accelerated over the last 2 quarters, even as retail investors have steadily liquidated their positions out of fatigue. This sharp divergence between retail exit patterns and institutional positioning creates a massive structural gap in market pricing, signaling that major institutional pools are quietly building defensive stakes before the broader market recognizes the shift toward enterprise-level agentic orchestration frameworks. The widespread expectation surrounding this software enterprise is quite straightforward. If you browse mainstream investing sites or glance at discussions across the Robinhood app, the dominant narrative is that the enterprise is stuck in a low-growth trap, struggling to move beyond its legacy roots in robotic process automation. Investors who engaged in self-investing during the high-flying software boom of a few years ago look at the current price and feel a sense of disappointment, viewing it as a yesterday asset that has lost its competitive edge to newer generative artificial intelligence platforms. The common ground among casual market participants is that large-scale language models will completely replace the need for traditional software workflows, rendering the company's core products redundant. But this basic assumption completely misreads how large corporations actually function. The reality is that raw language models are notoriously unstable and prone to hallucinations, making them completely unsafe for executing multi-step corporate functions without a rigid enterprise-grade execution layer. By positioning its software platform as the fundamental control plane that coordinates these new digital agents, the enterprise is making itself more sticky, not less, directly challenging the prevailing narrative that it is being left behind. When analyzing recent stock movements, the daily trading swings reveal an intense battle between short-term macro pressures and long-term fundamental support. The trading volume has seen significant spikes on downward days, which initially looks bearish, but a deeper inspection of order flow data across advanced systems like the Interactive Brokers platform reveals heavy institutional absorbing patterns near the $10 support level. Over the past 52 weeks, the stock has carved out a wide trading range between $9.20 on the lower end and $19.84 on the higher end, highlighting the profound volatility that characterizes this specific segment of the tech market. Traders utilizing individual brokerage accounts or active features on the Fidelity trading platform have observed that the stock repeatedly meets heavy selling pressure whenever it approaches the $15 mark, primarily due to systematic tax loss selling and programmatic portfolio rebalancing by multi-strategy hedge funds. Sector momentum within enterprise software has been highly fragmented, with capital disproportionately rotating into massive hardware providers like NVIDIA stock or mega-cap leaders like Apple stock and Tesla stock. This relentless concentration of capital into a few tech giants has starved mid-cap software names of necessary liquidity, artificially suppressing their valuation multiples regardless of their operational performance. Furthermore, macroeconomic pressures such as sustained higher interest rates and tightened corporate IT budgets have forced organizations to demand a clear return on investment before signing multi-year software contracts. This shifting corporate behavior was explicitly reflected in the recent earnings reactions, where the company posted mixed financial results that initially rattled the market. In the fiscal first quarter of 27, the enterprise delivered a revenue beat at $418.38 million against Wall Street estimates of $397.48 million, showing a resilient year-over-year expansion of over 15%. However, the stock suffered a sharp temporary pullback because non-GAAP earnings per share missed consensus estimates by a fraction of a penny, coming in at 15 cents per share. This hypersensitive market reaction underscores the tension between what short-term momentum algorithms expect and the actual operational pacing of the business. Investors managing their portfolios through automated services like Schwab Intelligent Portfolios or a SoFi robo-advisor frequently see these automated sell-offs trigger without human intervention, exacerbating downside volatility before value-oriented investors step in to stabilize the equity. The most impressive fundamental metric that continues to sustain the interest of professional money managers is the company's exceptional gross margin, which remains rock solid at approximately 83%. A gross margin of this magnitude indicates immense pricing power and operational efficiency, showing that the underlying cost of delivering their software platform is remarkably low. When retail traders perform online investing through standard brokerage platforms, they often over-index on bottom-line net income fluctuations while ignoring these clean, top-of-the-funnel efficiency metrics. The organization has been actively working to transition its legacy contract structure into a highly predictable annual recurring revenue model. This strategic shift is designed to smooth out the lumpy quarterly license sales that historically caused massive swings in financial reporting, providing a much cleaner long-term financial runway that appeals to risk-averse wealth managers who allocate capital across premium vehicles like Fidelity mutual funds or structured Fidelity investments. To fully understand where this enterprise is headed, it is necessary to examine its core business model and structural foundation. Founded in 2005 in Bucharest, Romania, by software engineers Daniel Deans and Marius Tirca, the company began as a small operation focused on building desktop automation tools. Over the next decade, the founders recognized that large enterprises were spending millions of hours on highly repetitive, rules-based digital tasks like manual data entry, invoice processing, and cross-application record updates. This core technology addressed a massive corporate pain point, allowing Fortune 500 companies to achieve significant operational cost savings without undergoing expensive multi-year overhauls of their underlying mainframes and databases. This rapid corporate adoption culminated in one of the largest software public offerings in United States history when the company listed its shares on the New York Stock Exchange in April of 2021. The original operational thesis relied heavily on selling software licenses alongside dedicated support services across key international regions, including the United States, Romania, the UK, and Japan. However, as the broader technology environment shifted toward cloud computing and complex algorithms, the enterprise had to evolve. The old framework of simply automating isolated static tasks began to bump against natural enterprise ceilings. In response, management aggressively expanded the scope of its core offering into a comprehensive business automation platform. This architecture integrates traditional software robots with cognitive capabilities like document understanding, natural language processing, and system intelligence. The platform uses a centralized management engine known as the orchestrator, which allows corporate IT departments to deploy, monitor, and govern thousands of automated workflows simultaneously across cloud and on-premises environments. This system intelligence layer is what separates the company from basic open-source automation scripts, giving it a strong competitive moat in heavily regulated industries like banking, healthcare, and public sector operations, where compliance and auditability are absolutely non-negotiable. Looking toward the future, the enterprise faces a dynamic environment filled with distinct operational scenarios, clear catalysts, and notable risks. The most significant upcoming catalyst is the commercial scaling of its newly launched agentic architecture and builder tools, which enable developers to combine traditional software robots with advanced digital agents capable of dynamic reasoning and independent decision-making. If large-scale corporate clients adopt this advanced framework to handle complex non-linear workflows, the enterprise could see a substantial acceleration in average contract value and net retention rates. However, the risk side of the equation cannot be ignored. The competitive landscape is becoming increasingly fierce, with massive cloud infrastructure providers building native automation tools directly into their operating systems, potentially undercutting the company's pricing model. Additionally, execution risks during management transitions can create internal friction, as seen when co-founders